Let's get more in the markets. We're joined by Ryan Detrick, Chief Market Strategist at Carson Group. Ryan, thanks very much. You do see one possibly positive sign in the market right now. Breadth is holding up. Just remind us what you mean by breadth and why is that a good thing?
Yeah, thanks for having me back. And, it's nice to talk about some positives for a change. So we've got some positives out there, but one that's really struck me is market breadth. Now, keep this simple for the listeners. We know the stock market, right? The S&P, the Dow, all these indices, but breadth is underneath the surface. How many stocks are going up versus down? So what we're seeing under the surface right now to us is really encouraging. The last 2 weeks on the S&P 500, 6 different days, again, the last 2 weeks, that's the last 10 trading days, 6 times, we saw more than 70% of all the stocks on the NYSE positive. That is extremely rare. That is a blast of buying, a blast of strength. Yes, the stock markets are up. We get it. But the breadth under the surface here, Andrew, is what we're really, really encouraged by. And to keep this real simple, when you see previous times like that, it's really rare. You're talking times like the lows in 82, the lows in 2009. There's a time in 2011. There's another time in 2020. 7 different times we've seen a blast of strength like this, like we just saw the last 2 weeks. 6 months later, S&P never lower. 1 year later, never lower. Small sample size, yes, but this is a last comment on this. This is a clue to us. There's something happening under the surface that's really, really positive. We get the headlines, we get the risk. We're not minimizing any of those things. But this is the first good thing we've seen in a while, I'd say.
That's interesting. And I think you may have mentioned this, but the April 2024 lows, let's pull up a 5-year chart for the S&P 500. They have shown up as support.
Yeah, they did, just right under around 4,900-ish, close enough for government work. Also, if you go a little bit further out, I can't see quite the chart you're showing, but if you have the early 2002 peak, the early 2002 peak on the S&P was right around 4820. That's ballpark where we just bottomed. So you've got previous resistance should be support. You've got the April lows. We've got over the top negative sentiment, rightfully so. I mean, we virtually had a bear market. We just barely missed it on the S&P, but a lot of other places had bear markets. It sure felt like a bear market a couple weeks ago if you were investing. But with all that negativity, before I came on, right? China said, no, we're not even talking to the U.S. But I mean, they probably are. But whatever you want to believe in that, the over the top negativity just got so extreme in our opinion. Now we're in earnings season, and trust me, it is murky. We can get a little more into it if you want. The reality is companies are not giving much guidance. But all in all, just look at today's last comment here. Initial jobless claims in the U.S. still pretty darn low. If we see a spike in initial jobless claims, that tells us companies indeed are worried about what's going on. They're laying people off. I'm not saying that's not coming, but we're just not seeing it yet. So we'd still say the odds of recession are fairly, they're higher than they were 2 months ago, don't get me wrong, but it's still not the likely scenario. And the market's pricing in just a terrible amount of news. That's why we're bouncing, and we probably made the lows in our opinion.
Made the lows for equities?
Yeah, we think so. Yeah, we pulled back. I think another thing I sent you, I don't know if you have the chart, but we pulled back on the S&P about 19% peak to trough, or on a closing basis. Interestingly, we've seen a bunch of 19%ers in 2011, 1998, 2018, thinking 76, 77, another time where you get right up on the cusp of a bear market, and then you bottom, and then you go higher. Now, intraday, yes, we hit technically a bear market, but with the market breadth things I just noted, that's a real positive. Maybe we go back down and test those lows. Do we violate it? As of now, with what we know, we'd say no. One more comment on, putting it all together. We look at the credit markets, right? Okay. High yield investment grade corporate bonds are down like 1.5% this year. S&P is down 8 or 9 the time we're doing this. High yield bonds are hanging in there. If you look at spreads, right? Corporate triple B spreads and different types of spreads on the credit market, keep it real simple. There's a monster under the bed. To us, we'd be seeing a lot more stress in the credit markets. It's really impressive to us how well the credit markets have hung in there with all this uncertainty. Again, some positives in a sea of negativity.
That's interesting. Yeah, the bond market, of course, it has sober practitioners. They're not the most fun people always, but they do tend to be very risk averse. Ryan, leave us though with a final thought. There are real threats though to the U.S. economy. We've got prices already going up, and we're only seeing the beginning of these hikes because of supply chain disruption and tariffs.
Yeah. No, you're right. And this is the ultimate question. There is a difference between the economy and the stock market. The economy in the U.S. is slowing. We're probably going to have a negative GDP print in the first quarter. We might have another negative one. Now, by definition, 2 negative quarters of GDP is not a recession. It used to be a long time ago, but that's a slowdown. We're just going to leave it at that. But what's the market price again? I mean, a lot of those Mag 7 names virtually cut down 30, 40%. We just had pretty much a bear market. What's priced in, what's not? Maybe we have a little bit of a slowdown. Maybe we have if there's such thing as it's like being a little bit pregnant, still a minor recession, but the market's pricing in a lot of bad stuff. So it's important to kind of remember those two things don't always jive. And again, from a market point of view, we think there's still some pretty good opportunities. Last comment, globally, yeah, the U.S. is down, we get it, but most of the rest of the world, as I'm sure your listeners know, is doing okay this year, right? The market ex-U.S. is up like 6 or 7% this year. So there are some opportunities for a diversified portfolio just for the U.S. investors that I usually deal with. Hadn't been a fun year, but listen, there are opportunities out there. I think it's important to remember that.
Ryan, always great hearing from you. Thank you very much indeed.